of a formation, you measure that formation, which in this case was 25 years, and multiply it by 0.6. And it will outperform for 13 years, which it did. The food companies had not changed at all, but they went into a bull market. So I go to Abu Dhabi in 90. I said, you don't have any food stocks in the portfolio. And they said, well, the earnings growth is so small. I said, earnings growth? I said, they're going straight up, in relative terms. Why don't you have any? So again, the focus was not on the share price. The focus was on the earnings. And I use the cycles. For example, if a stock or a group or a sector is in a big formation, I use the cycles to try and determine when it will break out.
Yeah. Thanks, Bill. I just need to make a short info for our watchers because we had some technical hiccups in the first 2 minutes. Okay. The stream just didn't start. So therefore, for the colleagues of yours who just joined in the last minutes and had not the intro, we have Bill Sarubbi today as special guest in our Cycles TV series for today. Bill is also a member of the board of the foundation, so and I'm happy to have him here with his over 50 years of experience in the market analysis and cycle analysis area, and we just discussed his experience related to fund management, cycle analysis, trading on the stock market, and I think Bill has done all these jobs during the last 50 years. So I think we can only go to your lips and just listen to your experience based on that. So, and I mean, we want to look forward. Also in the foundation, we will doing the annual preview starting next year. And I think you have also prepared a little bit some cyclic preview for next year.
Yes.
So would you like to share it? So should we have a joint view on your prepared?
Let me share screen with you.
Yes, please.
Now, I presume you can see that. I know there's a little bit of a delay.
Yes, we can see your screen and we can hear your voice. All good. Okay.
The way I look at it, the fundamentals have been eroding. We have a slower economy. Inflation and crime are ruining retail. And what we'll see here is the real estate cycle tops in 2023. The stock market usually responds to the fundamentals 1 year in advance. There is also the potential of international conflict. And as one wise man once said, don't tell me what is going to happen. I know what is going to happen. Tell me when it's going to happen. That is one of the basic pieces of wisdom that I've relied on over the years. So the summary for 2022 is the stock market, if it hasn't topped already, it's going to top in April, May. Why April, May? We have the sell in May period, which it runs from May until October. And it's an old axiom, sell in May and go away. But for the last 2 years, for the first time in history, sell in May has been up. Well, if sell in May is strong, which it was, then the odds of an October to May round are very strong. And that's what I've been going with. But the technicals, as we'll see, have deteriorated very badly in the last month. So prices may rise into April, May at the latest. The top may have been already. Now, technology stocks. I've got a way of looking at the cycles in the technology stocks individually. Well, what is a technology group made up of? But they say it's not a stock market, it's a market of stocks. If I have cyclical reasons to be bearish on individual technology stocks right now, and especially next month when they report earnings, I think technology is not going to perform as well as it has for the last 3 years. It's already pressing its luck, we'll say. U.S. notes, I think, are up into May. Gold is in a volatile trading range. The gold cycles, one of the dangers of cycles analysis, there's been a big fundamental change called Bitcoin. And a lot of money is going into Bitcoin that would have gone into gold. The U.S. dollar is higher. And as my friends in Abu Dhabi say, when things get tough overseas, you go to America. And I think that's what's pushing the dollar up and will continue to keep it up. I've seen this happen many times. Now, auction news. How much money do people have? There's an old saying in New York from the 70s and I think it was the 80s. Cocaine is nature's way of telling you you have too much money. Well, auctions like this are the market's way of telling you that there's too much money in circulation. Here's a new Super Mario unopened video game that went for $1.54 million. I could give you a dozen of these. I'll give you two. Here is a baseball card. This is Mike Trout. The minimum bid was $1 million. It went for $3.9 million. That's one baseball card. This is the sign of hysterical euphoria. And I'm going to move on. Apply contrary opinion to this Time magazine. That's Elon Musk. Now, Paul McRae Montgomery was a very brilliant analyst, my old friend who lived in Newport News, Virginia. He did a study of 3,200 covers of Time magazine and found when there was an investment-related story on the cover within an average of 4 months, with a probability of 80%, the price of that asset went in the opposite direction to that which the cover of the magazine suggested. And the effect was especially potent on non-financial magazines because that meant the story was so strong it penetrated through into the general public. So this is Time magazine, Elon Musk, and of course the stock is Tesla. And here's contrary opinion. Jeff Bezos appeared on the cover of Time back in 2000, and that's when the Time magazine cover appeared. And look what happened to the price of Amazon. I think it was down 80 or 90%. So this is another sign of euphoria. These are sentiment indicators. Now, this is my current S&P monthly cycle. This is my own software, which I've made a lot of improvements to and a lot of additions. And you'll notice it forecasts a down January, which I would have guessed anyway, some recovery February and March. But now you get out to April. Remember I said that if the sell in May period is strong, then we could carry through into April, May. But then look at the rest of the year. And one of the tools I've noticed between November and January is an important time period because I was in institutional brokerage, retail brokerage, with a big fund for 14 years. What do you do between November and the end of the holiday season? You decide what the market will do in the next year. Then you take big positions. You're usually done sometime in January. Once you've taken them, you're not going to turn around and sell the stocks in a month like a retail investor. You're going to hold. So right now, this weakness in the market is telling me that institutions don't like what they're seeing fundamentally, whether they're right or wrong, and they're selling. So if the market is weak between November and January, it's going to tend to be weak for the rest of the year. So that is my outlook on the S&P.
Bill,
let's see what's next year. Well,
wait a second, if you allow me, because this is, or the chart you're currently sharing is interesting because we are doing a similar with the cycles application here with our members.
Sure.
So what you're showing is a kind of composite, right? So there are 2 or 3 cycles involved in this forecast. I'm
going to guess there are 6 to 8.
6 to 8. How do you select these 6 to 8? Can you explain a little bit how the process works until you come up with this forecast?
Well, it's a sine wave process. Yeah. It is a spectral analysis. And then each of the cycles is run through an analysis to show whether it's been profitable or not.
Okay, so that's similar. So what we are anyhow doing. So so you use the kind of profitability score on each cycle to decide if you want to
correct.
Select the cycle in your composite or not.
As I say, I hang out. I wanted to get into the PhD program here in Vienna. They didn't let me in, but I talked to these guys and I say, well, they show me the work they're doing. I said, that's great if you want to win the Nobel Prize in financial forecasting, but I'm trying to make money. That's the difference.
Okay, so why you choose 6 or 8? So if there is a cycle which
I don't choose it. It hits a certain cutoff level, and if it's only one cycle, it's one cycle. It might be 12. It might be 6.
Yeah. Okay. So the cutoff.
And I have a monitor. I have a monitor, Lars, that tells me how much money is being made with this model, and if that starts to decline, I notice it, and if it moves to a negative return, I re-optimize it. That means the cycles have finally gotten out of whack. They finally are no longer accurately describing price movement. The most accurate one I've had has been oil. I haven't changed oil all year long, and it showed a peak on the first week in November, and it's been correct ever since.
Okay. So and you update your charts. I mean, this monthly then once a month, so that there will be
when the monitor tells me it's no longer working. When it goes to, we're trying to make money. So if it goes to a minus sign, I don't want to lose money. I re-optimize it. And gold has been difficult because I think money is being siphoned off into Bitcoin. I've re-optimized gold, I think 2 or 3 times this year, and I usually don't do that.
Yeah. No, that's interesting because you for you it's a normal process what you're doing on your day-to-day analysis, but I think it's important for our members which are finding her or his own way how to select the right cycles. In regards to the amplitude which you're showing here, does it mean that in April to expect a higher top, or could this just be another top?
The amplitude, it's just direction. It doesn't tell me anything about highs or lows. Nope.
Okay, that's the same with our how we do the cycle analysis every week here. So the amplitude, so it's just for timing, right? So it's not in regards to the absolute price targets. Okay, thank you. So that's the monthly analysis. So then.
Yeah. And the other cycle, this is where I started out, the 1, 4, and 10-year cycle. The 1-year cycle is obviously the seasonal cycle. And truth be known, I did this at MIT. I said, how many people here follow this seasonal cycle? And about 80% of the people raised their hands. And I pointed out, I said, where do you get the information? From a calendar. How is a calendar derived? Relative position of the Earth and the Sun. So it's a planetary cycle, and it's elliptical. It's not circular. And immediately, the 80% of the people who raise their hands, about half of them start to look very sour. And it's something that's not within our control. And then we have the election year cycle, which is 4 years long, which people attribute to the Federal Reserve dressing up the economy by injecting in funds just before the election, which is fine. But as my late friend Ian Notley pointed out, this 4-year cycle existed prior to the establishment of the Federal Reserve in 1913, and it exists in nations where you have a 4-year a 4-year election cycle, a 6-year cycle, an 8-year cycle, or no elections whatsoever. In other words, there's a 4-year cycle. And the decennial pattern was developed by Edgar Lawrence Smith of Ameritrust Bank in Cleveland. And for example, years ending in 0 have had the worst returns. Years ending in 2 usually show stock market lows. Years ending in 5 have shown the best returns. Years ending in 7 or 8, especially 7, usually been corrections. And according to my panic index, which we can talk about another time, most panics have occurred in the months of October and November in years ending in 7 or 8, which supports what Ameritrust found. So according to this is the summation of the 1, 4, and the 10-year cycle. And as you can see, it is really this down sweep in the decennial cycle that is really pulling this index down. So this, according to this, you've got, I'm just using this as a confirmation. And by the way, in 2016, I was ranked #1 stock market timer by Timer Digest using this cycle and confirming it with the 10-day moving average of advances and declines. And those are my 2 major tools. I did not refer to the other tools in that year. It hasn't been that good since because inflation distorts everything. So, year ending in 0 wasn't too terrible. Year ending in 1 was good. Now we're in the year ending in 2. We should have a low, but the market's already up. So that's the type of problems one runs into with currency inflation.
Yeah.
And now Bill, if I can go to the next one.
Wait a second. Wait a second, Bill. You're too fast, and we need to have a chance to follow. Can you switch back to your previous? Yes. Let's talk.
I'm from New York. That's why I'm too fast.
Yeah. Sorry for interrupting you, but I think the other chart. So the next one, not the monthly. So let's stick to the 1 and 4 and 10-year cycle. I think you should. Yeah. The annual cycle. Let's talk for a second on your annual cycle, or the red one, which is shown on the top front. So the red one. Yeah. This is not. I mean, it looks also like a composite of cycles. This is not one clear cycle or one sine wave. So how do you?
No, it's the addition of all. Yeah. It's all years since 1885.
1885. So wow. So 120, 130 years.
It's and the Dow Jones.
Yeah.
That's it.
Okay, and that's the averaged movement then within each year, averaged, which we see here as a.
That's correct. It's just the seasonal cycle. Yep.
Yeah,
that's all it is.
Exactly. So the seasons each year are summarized, and then the 4 years or the election year cycle, you call it. I think it refers to the 4-year cycle. That's also a combination of 2 or 3 cycles, I think.
It's taking every 4 years and averaging them out.
Okay. So this is not. So this is why I wanted to pause for a second. So this is not where you do digital signal processing and select some cycles which have performed best. I think this was the monthly chart before. This is now the averaging the 1, 4, and 10 years. What you're showing here.
Yes.
Yeah. Okay. Thank you. Now, I think that's important to understand that how your process works. Thanks.
I mean, for example, the way I use this is you'll notice I picked April before. Now look at the sum of the 1, 4, and 10-year cycle and look at the individual. This one's down, this one's down, the sum is down. So this is confirming what I've already seen. So I use it as a confirming factor.
So this supports what you've shown in the monthly analysis just a second before, right?
That's correct.
Yeah. So, yes. Okay, thank you. No, then let's continue. I just wanted to make it clear for everyone.
Okay. So as my old friend Teddy Butler Henderson, who ran London's largest investment bank, which was run by his father before him, and Teddy passed away in his mid-80s. He was a walking history book on economics. He would say, to understand the longer term, you really have to understand fundamentals. And one of my bosses said, the long-term price movements are based upon the fundamentals. So just tell me what's going to happen in the long term, and I'll give you the ideal investment strategy. So you're back to square one, knowing what's going to happen in the future. There's a very regular 18-year cycle in real estate, and this comes from my friend Phil Anderson. And the name of his highly recommended book is The Secret Life of Banking and Real Estate. Mm-hmm. And in that book, he pulls out a book written by some fellow I never heard of, Fred Harrison. And this comes from Harrison. It's represented. That book is out of print as far as I can see. It's been saved from the dustbin of history by Phil. And you see the real estate cycle runs 7 years of gradually rising prices. Now, the way I read this and what I observed over the years is that there's been a crash in real estate. It's back here, over here, where you see the 4. Now, the people start to slowly recover. And after 7 years, they said, well, the real estate prices really haven't fallen, and so let's start buying heavily. And then they create a boom. Mm-hmm. And then at the end of 14 years, you get the crash. Now, Phil and I agreed. I said to Phil, 2016, which is was an election year, the election will give greater confidence to investors, and they'll start to push up real estate more aggressively, and plus that the Federal Reserve will probably be very accommodative. And he and I both agree that 2023 is the top. Now, the last time this index topped, I was warning everybody. I said by June 30th, 2006, if you have any real estate sales planned, execute them by June 30th, 2006. And if you want to buy, wait a couple of years. Now, the place I own in New Jersey, I bought in 2011, and it's now worth 4 times what I paid for it. And I was looking at this cycle. And so right now, I'm not buying anything. I don't have anything to sell, really. So my advice is if you want to sell, do it in 2022. And if you want to buy, wait a couple of years.
Yeah.
Now, the stock market looks forward 1 year. Mm-hmm. If real estate turns down, most American consumers consider the inflated value of their home to be like a piggy bank. They can take out a second mortgage. It's like an inflated credit card. When that bubble bursts, when that shrinks, they start to cut back on their spending. So I think that is what the stock market is reacting to, in addition to all the other problems like inflation.
But the stock market is taking this prior to the real estate cycle, you mean, no? So this will take it into account. Prior, yeah. Yes, it will take it into account already next year, and then the real estate crash might follow. But it's not a very positive outlook, by the way.
No. Well, if we look forward, now this is the same analysis you just saw on the S&P, but it's done on the XLK Technology Index ETF. And I would rather have more history, but I don't, because they have no idea of the value. The people who keep the data have no idea of the value of the integrity of the data which they keep. So this is the technology index, and that looks certainly down in January, which I had already forecasted based upon cycles on the individual stocks. But let's go one further. There's the real estate sector select ETF. Now, if real estate is, if technology starts to drop sharply, you've got to move the money somewhere else, and I'm betting a lot of that is going to go into the real estate index, the real estate sector. So this is an example of using cycles to pick sectors.
Yeah. So
you could also pick groups or individual stocks.
Also a little bit for risk management, right? So that you say, okay, the technology area might be risky in regards to the upwards potential, and the real estate might be a lower risk, at least next year. I mean, so to shift between these sectors.
Now this is the XLE energy sector, but this is the stocks. It's the equities. It's not the price of oil. So usually if you have I wanted to show you just how accurate it's been. That's why I have this price data in here. See, this was taken, Lars, I showed this to you exactly 1 year ago, and I took it from that presentation.
You're right, yeah.
So that was December. That's December, which is right here. And I presented this predicting a bull market that would last into November, which just passed last month.
Yeah.
So I'm just proving out the value of the cycles. I got that from our last presentation.
Yeah, that's right. Good
this
point.
Is the 10-year. This is the 10-year note. This is a projection. I won't spend too much time on this, but
wait a second,
March,
Bill.
June, September.
Sorry for interrupting you again, but there's the question now from the audience in regards. Can you repeat the name of the book, please, which you referred with the real estate cycle?
Sure.
Yeah.
It is The Secret Life of Banking and Real Estate by Phil Anderson, who lives in London. Secret Life of Banking and Real Estate.
Thank you.
And he discusses credit cycles in the first part of the book and the real estate cycle in the second part. But this has been a very, very regular 18-year cycle. And if you go to the Foundation for the Study of Cycles, if you go to Ed Dewey's book on cycles, there are many, 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 many 18-year cycles throughout nature.
So,
here we go to the fixed income market, the 10-year note. Based on fundamentals, I would expect rates to rise, but it doesn't show that for next year. I do have some longer-term interest rate cycles, which I have to look at, which I haven't had a chance to look at yet. And I'm going to move a little. Now, that is the note's seasonality. Now, I do this. That's the projection for the year, and that is the average of any year. Let me just describe the graph a little. Red is a probability of a rise. So you can see the probability of a rise in 41 Januaries. We have to look over here. That's 60%. So you can see November has been the strongest month. The blue is the average price return. Now the green is the product of the red and the blue. In other words, that is the expected return. So you'll see March, September are weak. You'll notice August is strong. Now, my thesis, one of the big tools I use, if this is pointing up and this is pointing up, you have a very high probability of a rise. Because look, if we're over here, Lars, and it's October, will notes go up? Well, you look here and say, well, they're up almost 70% of the time anyway. Well, let's look over here. Are they up at that time? And the answer here is no, not quite. But I try to match them because this is the average of the last 41, 42 years, and that's just an average. So I have to presume if the monthly cycle is pointing up in November, the odds are not 68%. The odds have got to be in excess at least 10% higher. Now you're pushing 72%. And there's an old saying on Wall Street, if you can be right 60% of the time, you can make a fortune.
Yeah. So, and please wait here, because I think now you show an interesting method anyhow. So you use the cycle analysis, which your previous chart you showed, which we discussed in the beginning, where you select the combination of 5, 6, 10 cycles based on their profitability, or you say the composite should give you guidance in past profitability, and then you don't switch the setting. These cycles have been detected by cycle analysis and digital signal processing to build the composite. And this is then now a second method, which just uses this seasonality, where you then cluster the performance for each month.
Well, this is where I start. I'm sure Jake Bernstein, our friend on the board, would agree. I mean, look at this. Look at the month of March. Now, a quick, let's see, funny story. Where is March? Okay. I'm over here. You see this here, February, and I'm meeting with the head of one of the largest insurance companies in Europe. And he says, well, what do you think bonds will do next month? Well, that's like asking if there's going to be rain in London and sunshine in Abu Dhabi. I said, well, they're going to go down. 1 year later, he says, you were right a year ago. It happened to be February again. 12 months later, what do you think? What will happen? I said, notes will go down. And they called me up and they made a consulting arrangement with me. I said, asking me that is an easy one,
So,
I start with this and I try and confirm it with the dynamic. This is the static cycle. It changes very little. The other one is a dynamic cycle. It changes all the time.
Yeah. What is the dynamic?
And so let me just get through. Yeah.
What you fire out these words so quickly. You just mentioned the dynamic cycle. What's the dynamic out of these two?
A dynamic cycle is extracted from the most recent data. So therefore, like the daily and weekly cycles change frequently.
Yeah. So you update this.
So I can run that on any portfolio. I could run it. I could run the entire S&P 500 daily to show you what cycles. And I only go to the top 10 or 20 that show that 100% of the buy signals have been correct, or 100% of the sell signals have been correct. But the daily changes frequently, the weekly somewhat frequently, and the annual doesn't change that much. But these cycles are static. So you've got to ask yourself, well, we're here and we have a bond portfolio. We know that March is usually weak, but that's only the 1 year cycle. Aren't there other cycles? And of course, anybody who's familiar with the foundation work is going to say yes. So the dynamic looks at all cycles and tests them in two ways, quantitatively and by the dreadfully capitalist way of how much money you make.
Yeah. No,
which should send all leftists running away. Yeah.
No, that's fine. This is I'm just referring, or wanted to hear it from your words, because this is why we also need to update the cycle analysis once we have new data, because cycles they change their length and their phase slightly. So I mean, they will never. Right. They will never have the same length of 170 days or whatever. One day it will look like 175 days, and maybe a week later it will have 168 days, but it's still the same cycle.
Yes, and I'll just pass on one thing. I run through these tests, and natural gas seems to be impervious to any cycles analysis. I stay completely away from natural gas. It is just too volatile to use cycles on, and I try and stick with those that are reliable. Yeah. But if I can just jump forward one, with this is gold. Gold is not showing me, let me see, I don't have the gold seasonality in here, but it's not really showing me. I mean, for example, this time of the year, August through the end of the year is usually strong, but look at the dynamic cycle. So the dynamic cycle conflicts with the usual calendar year. And I'm attributing this to a lot of money going into Bitcoin and real estate and not into gold.
Mm-hmm. So,
that's one I'm not going to rely on too much.
Mm-hmm. But wait a second here again. So this is a gold chart, and what's the combination of cycles for 2022? Because you mentioned you're starting your analysis.
I can't tell you. I can't tell you the cycles. I'd have to fire up the program and read the cycles. No. I just don't remember which ones were selected.
I just wondered, is it a monthly again, or is it? I think it's a monthly chart again, right? Or
this is monthly. Oh, sure, yeah.
Yeah. Sorry, just not sure. So it's the same procedure as you started with your first one, right? So you're running these monthly cycle analysis
it's a standard procedure.
Yeah, exactly.
I'm trying to take asset classes and put them on a standard basis for analysis in terms of timing.
So what's the takeaway, or how would you read this composite here? I mean, you summarized it very quickly in the because it looks like there are some little ups and downs during the year, but then the large amplitude is maybe seen at the end
of a trading range. It's more like this time of the year. January and February are usually strong anyway. March is not. And so this matches up pretty well with the seasonality. And usually the gold market bottoms either June or August seasonally and runs straight up. But look at this. You're getting, so at best, I think you'll get a flat gold market in the, if you're only looking at the seasonality, you may be disappointed from June until December because this cycle is going down while the other one's going up. And the result may be just a trading range.
That's right. And then let's come to your second point. So you're thinking that the activity in crypto, or the interest crypto is currently getting, will influence or will make the cycles in gold not as reliable as they have been in the past?
Yes, I was sitting with professors here at Vienna at the university, also the von Mises Institute, of which I'm a member, which is down at Auburn University, and I always throw the question out to economists and other people on Wall Street. What is Bitcoin? Is it really money? And everyone went through, they said, well, it's and I got this immediately. There's a relatively fixed amount of gold. There's a relatively fixed amount of cryptocurrency because of the way it's set up. Therefore, it's got a quality that gold that it shares with gold, but in gold with Bitcoins you don't have to store gold in a vault or a locker or have a third party. You're storing it in on the net, and it's quick and easy to make transactions. So I think that is very stiff competition for gold.
Do you have some crypto cycles? I don't know if you've prepared something, but
No, I didn't. No, but if you go to Forbes, Bill Sarubbi, Rate Speculations, I put out something on Bitcoin last week. Yes, and I put out a sell signal on the Abu Dhabi stock market today.
Yeah, wait a second. I will use the chance to introduce our audience here on exactly this. Your homepage. So I would recommend anyone who is interested to learn more from Bill. He is a regular writer on the Forbes magazine in the market section. You will find him just Googling his name with Forbes, and then you will see. And I saw this. I think you made a article here on Bitcoin a week ago, well, even not a week ago.
Last week.
For the Bitcoin cycles. So I just wanted to make the note here and recommend everyone to check out your page on Forbes. But Bill, maybe okay. Let's find an end. We don't want to run the full presentation. You will also do maybe in January anyhow. So.
Well, let me just say this is the view of the dollar, and if I took this axis away and showed it to any technician, they'd say, well, that's a falling wedge with a breakout. It's going to go higher. Well, look, it goes all the way back to 1880. So I think the dollar is going higher next year, and that is the same monthly projection for the dollar.
Yeah.
So
okay.
And this business activity index, this is from an old DOS program. That's why the chart looks so ancient. But this is based on the business activity index, which was generated by Ameritrust Bank. And they took every bit of economic data they could get from 1760 to the present. And I've been updating that and maintaining it because they stopped maintaining it in 1988. And so this is 6 cycles. The shortest is 12 years long. The longest is 36. And you notice a peak here. And I stated at that time, remember it's 2007, this is one of the reasons I was bearish on real estate. And then you got this long slide down, and I'm in here at London, and these gentlemen, much older and more experienced than myself, and, well, young man, this graph goes, why would the market go sideways for that many years? I said, well, because the Americans will elect a Jimmy Carter type president with a party that is not friendly to business. But in 2016, they'll elect a conservative person who is friendly to business and will have another boom. This was done in 1999, and it's just updated through here just to show you how the business activity. It's the longest business activity index
I think
could find, and that is the 20. Yeah.
Wait a second, because I think we couldn't see your chart for a second because the screen just didn't update. So I don't know. Now we see the 2021 cycle composite. We skipped the previous chart for whatever reason.
Okay, well, there's 2020. Let me just show you the objective here is to get to 2022, which is the next slide.
Yeah.
So there you see a low. So I'm interpreting this. Most people are just this morning on the news shows from America. They're looking at Florida and saying, "Hey, they've got economic growth. They got a boom because they have no lockdown." So I think this is indicating that idea is now going to spread and the economy is actually going to grow.
But what's this composite of?
It's the business activity index from 1780, which is put together by Ameritrust. They stitched together any bit of economic data they can get. They normalized it, strung it all together, and in 1988 they got bought out. And of course, the first thing you do when you buy a company out is you get rid of all the creative people who do this type of thing. And so I've been maintaining it ever since, right through my years in Abu Dhabi. And my earliest software was a DOS program that used fast Fourier transform to extract cycles out of data. Mm-hmm. And I found out that there were 6 cycles that described this best. The 12-year cycle was the strongest, and there's also a 36-year cycle in there. And there's a lot of 4 cycles in between those two. And I've been using this ever since. And
Yeah, now I got it, because we couldn't follow because the chart was not shown. So this is the business activity index, and you are continuing this data, right? And then that's how you build the cycle projection for 2022 you showed.
Well, I put it all together, and then Richard Moki and I, who's the director of the foundation in the 90s, got together and did a lot of work looking at this, and I generated this with my first software program, which is back in the days of DOS, which the young people won't remember. It was a day of steam-powered computers.
Yeah, so but this business activity index, so is this available anywhere else, or is this now your individual data collection topic?
Mine, but I think we can make it available through the foundation, because that's the place for it.
Yeah, so this would maybe a topic for us to follow up, so that we can bring this just as the index data into the cycles application, so that the members could also use this activity index.
We will talk about that, Lars. Okay.
Yeah, thank you. By the way, in parallel, there was also a question in the audience that Emma mentioned that sometimes you talk about Fib timing or Fibonacci timing. So do you use this in parallel for timing from high to low?
Fibonacci ratios?
Yeah.
Yes, I do, because that first program, the DOS program, we had in it. Shall I stop? I can stop sharing now, I guess.
Yeah. Let's have a final talk then. Yes.
And so we were putting that program together, and I said to the fellow who's doing the coding, we had Fibonacci expansions and retracements. I said, let's turn it this way and let's do them in price. And that was 1986. The program came out in 88. And yes, I work with those, and I work with day counts from highs and lows. And the cycles that you've seen, if you look at the seasonality, let's just say that there's a high in a market that's projected, let's say seasonally, January is very strong for asset class number 1. And you take a look at the dynamic cycle, it hits a peak in January. And then you do the Fibonacci expansions monthly, and they come out to January. It's not going to get much more clear than that.
Okay.
I mean, those come around once in a while, and because they come around infrequently, you expand the number of markets you look at, you put it on a standardized basis and say, where should I put the bulk of my money?
Yeah. Thanks, Bill. I mean, it's always fascinating how fast and quick you browse through your analysis and charts. So therefore, if we can have 5 minutes or 10 minutes of final discussion, this would help. So because
I come from New York, where it takes a half an hour to watch 60 Minutes.
Yeah, and I mean, you're doing this for 50 years, so we need to get a chance to follow you. But one of the key things I would like also to mention is that let's talk about, or let's call it, 3 cycle analysis. So we had Peter Iliadis here a week ago, and he also mentioned, based on his price target projections, that we might approach a very important high in the overall market. So that's similar to your outlook on the main stock market. So your latest in March, April next year, but maybe the top might be in. And we did a similar analysis here on weekly cycle analysis with our cycles signal processing tools. So,
yes.
And I mean, these are more or less 3 independent cycle researchers. I mean, we are using the same procedures in cycle analysis, but all the 3 point to more or less the same conclusion. I mean, not pointing to the exact day, but from now at least until end of the year, latest March, April, we still tell the same story. So that's interesting. So that your analysis and you're combining even more. You have monthly cycles, so you used monthly cycles. We did weekly cycles here in our weekly cycles TV, and Peter used a combination of different time frames also. So that's what I think is fascinating, and that's what Dewey also talked about when you see these clusters in cycle analysis, if they come to the same conclusion. So I think that's, I mean, we will have more on that maybe in 6 to 12 months, and then we can revisit the analysis. But you did it already with one chart you shared in November last year. Bill, and it's also fascinating because even though it was very quick, you showed that it's a kind of combination of different approaches. No? You call this dynamic cycles, which is then more the digital signal processing on current data. Then you have always the seasonality, which is a key part of you, which is static, right? So you can have hundreds or 150 years of data. This gives you kind of a static seasonality, and then you add this additional, market knowledge, but this is not the first priority. No, I think then a third component, your knowledge on market or Fibonacci, comes into play, something like that.
Yes.
Yeah. So and I mean these are the topics you need, and then not to talk about real trading, which is another expertise you need to have in regards to risk management, position management, selecting the correct areas. You talked about the shift between technology and real estate maybe in the next year. So that's why I always like to listen to experts like you, with have these 40, 50 years of experience. And I think therefore also for our members out there, it's very important to not only to listen, maybe also to record these sessions, that we are able to look it up. As said, even if you speak so quickly about your method, at least we can watch it once, twice, and a third time, and then maybe we get another important takeaway. Okay. I'm just checking the live chat. So if from the audience, if there is any question you want to ask us today, feel free to put it in the chat section. We will have a look there. And there's one current question from Jason, Bill. I will read it out. Our different analysis shows the cycles for timing and not magnitude. That's also what we discussed. So we're talking about points in time. Peter Eliades also talked about maybe an important significant top in regards to price. Do you have any thoughts on the magnitude besides your timing indication we discussed? So do you think this will be just interim? I mean, on real estate, you told us that you would expect a major top in 2023. What about the stock markets? Any idea about the magnitude of the timings you had?
You mean in terms of price?
Yes.
Well, I think it either the market has either made a high, but the thing that bothers me about that conclusion is I can see in the breadth and the new highs, new lows, it's very weak. But usually when you have a major high, you have absolute euphoria. All the bears have been driven back to Yellowstone National Park. There are no bears. There are nothing but bulls. And I don't see that. There's been, and I'll tell you how you can see this. There are numerous sentiment indicators. And one, who was many years ago in January, it's the National Investment Managers, so National NAIM, I think it's National Association of Investment Managers. They have an index of how invested the fund managers are in equities. And we started out January with them fully invested up at the top. 4 weeks later, it was at the bottom. I said, how bullish could these people be? I mean, that's like infantry that sees Napoleon's Imperial Guard marching toward them and they drop their muskets and they run away. What kind of positive sentiment is that? So what I'm fearful of, if the market starts dropping and sentiment stays up, in other words, people are buying the dip, that's a sign of a high. And sentiment has the positive sentiment just melts away instantly at the first sign of trouble.
That's
and
right.
that's one thing I've been keeping my eyes on, and I've been through. All I can tell you is, when I was 16 or so, I was just amazed by people on Wall Street. And I said, well, I said, what happened to so and so? And they said, well, he tapped out. And I said, what is tapped out? Is that like tap dancing? And they said, no, he's gone. I said, where did he go? Oh, he sold his company? No, he went out of business. How? And they said, well, he stayed, bullish, whatever, when the market turned down, and I didn't even know that could happen. And so the participants, like Frankie Joe stayed, he was on top of his game for 15 years. Very few people can do that. And it's usually always a different cast of characters, and very rarely does somebody last for a long time.
Yeah. So you're mentioning, and that's what we always also do here in the weekly updates. You talked about sentiment data, which maybe could be a confirming data set if a major top or major low might be in there. What sentiment data do you use or do you look at?
Oh, I watch the news. I look at magazine covers. I like to take ETFs. For example, gold has ETFs. One of them is UGL. UGL returns twice the gold price, up or down. And then there is one that returns, GLD, returns 1 times the gold price. Divide one by the other and create a ratio. If people are bullish on gold, if they're very bullish, the UGL will go up and up and up and up. The ratio will go up and up and up. And when it gets to a high, you'll see you're at a high in the stock market. And conversely, if people who are buying gold are buying the GLD, that says that they're not really that bullish, are they? If they're only buying 1 time when they could buy 2 times.
Mm-hmm. Yeah, okay.
They could do the same thing with the euro, and anywhere you have a multiplier ETF.
Okay, that's interesting. So you can build a ratio on that. Yeah. Two questions maybe from the audience also. Do you use any methods from GAN? Or do you add?
Yeah.
Yes. What types or what methods you think might be useful?
The time counts from highs and lows. I was taught this by George Lindsay, who was he wrote a market letter from 1953 up until when he died in the 80s, and he lived about 2 blocks from me in New York. So we used to share taxis home after presentations. And one night he took out a napkin and he said, "Well, it's 60 days from this high and 30 days from that high." And I said, "What does that have to do with anything?" And he explained to me day counts. And later on, I was to find out that W.D. Gann was a big proponent of day counts. And so that one I use. And I've read a lot of it. And to me, a lot of it, it's just sort of okay. But it's sort of like if you took my papers here after I croak and you look at them all, you could read some esoteric magic into it, which really isn't there.
Oh, okay. That's right, and then it might get different anyhow on the gun stuff. Finally, the gold chart you showed, also a question from the audience. Yes. It showed a bigger downturn in December. So yes, looking at the
normally a strong month.
Yeah, in regards to the amplitude. So and before you mentioned it might be just a tight range, right? So more consolidation or tight range. So is there any connection between this large amplitude drop in December from your gold chart? just from the audience?
Well, November and December are usually up. Those are static cycles. Dynamic cycles are usually superior to them because dynamic cycles are extracting the most recent data. For example, if we get out to September or October and that graph, that line is still pointing down, you've got the static cycles pointing up, the dynamic cycles pointing down. So I would say at that time, gold will probably not go to a new high. In other words, it'll be in a trading range.
Yeah, okay, thank you.
And I would mark off the last high and the last low and say it's probably going to stay in there and go back and forth.
Okay. And maybe just related to our discussion just a second ago. So you talked about the day counts or also related
days,
to
weeks, and months.
Yeah. I don't know, but the question is this related to also Demarc's indicators where he uses the 1 to 9 or 1 to 13 count, or I think it's different, or is it?
I can't say.
Okay. So it's just Tom Demarc showed also his day count, but I think it's different in regards to Gamma.
Well, let me just say that in 2007, Peter Eliades very clearly had a month count going back many years that was absolutely accurate. Mm-hmm. There are two people who got it. He got it, and a guy I know who follows the stock market who is a retired Swedish Airlines steward. He works in the airlines. He retired. He lives with his wife up in Copenhagen. They both used different counts, but came to the same conclusion, October of 2007. Mm-hmm. And right now, Bob Prechter and the Elliott Wave organization have a count, and my friend Stan Harley, they also have counts that come out to this year. And we managed to get through to November, and my thought it was going to be next year. And I hate to differ from people that I respect who have usually been accurate, but Stan thus far has said the top will be in November. But these counts do work. But if you look at, I have several sets of counts. One guy is using 15 months and 15, and the other guy is using something else, and yet they come to the same conclusion.
Yeah. I think when I get into this discussion with cycle counts or different views of cycles, I always see or hear the criticism about, you will always find some kind of count which has worked or not worked. So it's just a matter of how you count and what you select. So is there any real value in it? I mean, after the fact, you can always show me a count which has worked or not. So, and then, I mean, that's...
They did it before. They did it before the fact, back in 2007. They may have done it again now.
That's right. So there's that's what we need to look at. Okay, thank you, Bill. So I think we are running almost now for an hour. It always gets more interesting once we are running these discussions. But I would like to thank you for, first of all, show us your outlook for the next year, which is highly valuable, and to learn a little bit how you do this based on cycle analysis. I mean, that's the takeaway here. We don't want to do any market recommendations here at the foundations, but we also want to show that this is not pure data analysis. This is used by, for example, you with a huge background in the market. So it's always interesting to learn how this combination is done by guys like you and Peter and all the colleagues we have in the foundation. So, Bill, as I will take you by your words, we will talk about how to bring the business activity index maybe to the foundation. Yep. So this would be a great value also to the members to have it there. So you will help me on that, and I will help you, by the way, to bring in a new webcam so that we can improve the quality of these sessions then for next year. And then it's a win-win for all of us.
But, we'll do that. We'll be in touch.
Yeah. This would be then my Christmas present.
Okay.
So there's a seasonal cycle you know about. So it's a Christmas season. So just funny. So Bill, I mean, let's keep it serious. I just want to end the year now. But thanks for having you on the weekly show. I hope we will see you here next year. Maybe more often than this year. And by the way, then, or by doing that, we will work on the business activity index. So thanks for being here, Bill. Thank you, and have a nice
most
Christmas
welcome.
period.
Thank you for your kind invitation.
Sure. Bill, see you again. I will just close the session. So don't go away for all the viewers also out there, because what I need to talk with you about is that if you have not received the invitation for our market forecast 2022, at least please be aware of that running in January the 6th, you will see Bill, Jake, Andy and myself just giving you some presentations about what to actually. I mean, this is serious, right? This is not funny. This is serious stuff out there. So I'm not kidding here. So this will be a very great event, and I would invite all of you to for sure join these sessions. If you remember, this will be interesting. We will elaborate even more of what you've seen just today. So this will be going more into the details of all this stuff. So please join, please follow us. And now to close the year. So I have done this too early in the session here.
Okay.
I mean, this is the last session for this year. And therefore, as said, I hope that you all will have a great Christmas period for the next weeks to come. And also, as mentioned, so there should always be a fun cycle somewhere in your personal life, some happiness, some freedom, some silence with your friends and families. And I think now it's time also to take this cycle into account for your personal plannings. All the best for the year to come. Therefore, I was now every week here for the full last year. So please allow me a break until the 6th of January. And then we will resume also with the weekly Cycles TV here in next year. What you can do, please like the channel, subscribe, recommend the channel to others. I mean, we are doing this free here. We want to push the knowledge on cycles. And I would like to see every one of you starting in January here with fresh energy, revibrated for the next year to see what the cycles bring. We had some great predictions out during the last week for the main global markets, so we can revisit next year. And as we are interested in cycles research, we will visit it if it was a positive outlook, and we will also learn from it if it was not a positive outcome. So anyhow, we do cycles research here. That said, have a nice Christmas. Stay safe. We will see next year, same time, same place here at the Foundation. Bye.